Versace, Rolex, the St. Regis Hotel.
If you've ever walked down Manhattan's Fifth Avenue, you've probably noticed the glitzy shops, luxurious hotels, and very expensive restaurants. What would you guess the average income in this area is?
In this area, it's about $170,000.
Probably 200.
Guessing out of the top of my head, 200,000.
I'd say $500,000 to $5 million.
Not even close. At least not in the eyes of federal banking regulators, who are basically using older census data that say that the median family income in this neighborhood is about $45,000 a year.
By that calculation, the neighborhood is considered low income, and that brings big benefits to banks, like Wells Fargo, and Capital One, and TD Bank. Here's why. Under the Community Reinvestment Act, banks get credit for having branches in lower income areas. These branch locations boost their score on a key regulatory test known as the CRA exam, and that can help determine how fast the banks expand. The law, enacted about 4 decades ago, is meant to prevent discrimination against low-income borrowers and areas, but it has sparked debate in certain political circles. Proponents say that the law helps level the financial playing field by providing people in low-income areas access to loans and banking services. But critics argue that the law can encourage banks to make bad loans.
New York's ritzy Midtown area isn't the only example.
Over in California, 53 branches are packed into this small and expensive San Francisco area. And in Washington, D.C., 19 branches dot the streets of a neighborhood right next to the White House. Later this year, regulators will be updating their income designations based on more recent census data, but the rules change isn't likely to calm the debate about the Community Reinvestment Act.
But what it does mean is that some of those guesses folks had of income being roughly $100,000, $200,000 in this area will be right in the neighborhood.